Welcome to Westmount Wealth's Meet the Manager series, where we interview asset managers and look under the hood, asking questions that you want and need to know. Welcome to another installment of Westmount Wealth's Meet the Manager series. Today, we're talking private mortgages, and specifically private mortgages in the commercial lending space. And we're thrilled to have with us Keiju Yamasaki, who is the Global Head of Credit and Underwriting for Trez Capital. Trez is a well-known lender in the private lending space in Canada that just completed their 25th year of business. Keiju, welcome. We're excited to have you today. Matt, what are we going to talk about?
Keiju, why don't you start off with what a commercial mortgage is, how do you structure these loans, why would a borrower go with Trez, and then finally, how has this strategy performed?
So I think the first question was, what is a commercial mortgage? So for those that aren't aware, a commercial mortgage would be a financing vehicle secured against real estate. And in the case for Trez, most of our loans are for some type of development. Most easy to digest would be construction. Our focus from an asset class standpoint is residential. We focus on multifamily residential in Sunbelt states. And so again, when we use the term commercial, we mean commercial mortgages, commercial real estate. It's, for us, residential real estate, multifamily in the Sunbelt states in the US. And for those that aren't aware of what Sunbelt states are in the US, that would be states in the southern part of the US, including Texas, Arizona, Florida, the Carolinas, areas where there's high levels of migration within the United States.
So when you say commercial mortgages, you essentially, if I understand correctly, mean mortgages against real estate that are anything but single-family homes. So it could be apartment complexes, it could be development, it could be construction financing.
Yes. However, from an asset class standpoint, again, we don't generally do offices or retail. We do some industrial. So there's a mix of some of those things, but our focus is always primarily residential. We have a philosophy that is the asset class that we believe in, the strongest. So
Why residential?
It's resilient. I think we've seen what's happened to office in the last 36 months, particularly through COVID, and it's been very vulnerable, and there's a lot more nuances to how you sign up leases and get that type of asset stabilized and occupied, as opposed to, again, the need for housing in the US is something that we feel is fairly consistent and a bit more predictable. And we have a lot more expertise in that asset class because we focus so much on it.
So Keiju, why don't you tell us who the borrower typically is?
So the borrower in most cases is a developer. The developer is the group that is in charge of taking a project from a piece of land to a final development project, again, multifamily or what have you. They're the ones that are hiring the contractor, managing the contractor and the various trades, marketing it, doing all of that to launch a residential real estate project.
I guess the follow-up question would be, these must be very large companies, and if so, why wouldn't they just go through traditional financing methods like going to a regular bank?
Yeah, that's a great question. So the first part of the answer to that question is that typically in the alternative lending space where we participate, borrowers are able to get more proceeds. So they're able to lend, we're able to lend and they're able to borrow a little bit more money than if they went to a bank. Banks are just by nature a little bit more conservative. So if we take a budget, essentially the cost of developing a project, and let's just use easy numbers, if that was $100 million to develop a project, typically the proceeds, if you go to a bank in a normal environment, would be anywhere between 70 to 75 million. And with us, typically we would be lending somewhere between 75 to 80 million. Now, I will qualify that in today's environment with the various economic factors that are creating uncertainty, we're a little bit lower in terms of proceeds, but so are the banks. In fact, many banks, particularly in the US, are not lending at all into real estate. Or they have other strings that are attached based on certain regulatory requirements that they're required to meet. such as you have to have a whole bunch of deposits with us or other factors that they need before they'll even entertain having discussion around borrowing. So that's one of the things that we're able to deliver as we're focused on real estate.
So beyond just being able to borrow more, are there any other advantages to going to a private lender?
Yeah, I mean, there's a deep level of expertise where, our shop is only focused on real estate. So having that core level of expertise means a lot to a borrower, and a developer will know that on projects, things never just go exactly the way that they thought. And so whether that's a delay in the schedule or your elevators arrive a month late on site, there's always little things that happen, and being reactive is different than being able to be proactive. Have a conversation with your lender to say, hey, this issue is going to arise in a month, what can we do about it? And we're able to quickly pick up the pieces and figure out how to deal with those things. Whereas if you're dealing with a traditional bank, you may be dealing with a person that's not an expert in real estate, is just lending money like you would to any other business.
So what would a typical loan, obviously each loan would be different, tell us about what a typical loan might look like in terms of cost, length, terms.
Right. So to my earlier point around proceeds, which is a big deal for a lot of borrowers, again, we're looking at anywhere from 70 to 80% of the budget, depending on what type of environment we're operating in. Again, most people in today's environment are getting about 70% against the cost of a project. Now, the upside to us is that we look at a project in terms of its completed value. And so if somebody is investing $100 million to develop that project, you'd hope that they're going to have a project that's worth 120 or 130 million. So our loan to value, which is the completed value of the project, is usually sort of in the low 60s in today's environment.
Why does that matter?
It matters because you always want your borrower to be incentivized to complete the project. The profit in a project is what keeps people at the table, but also because in the worst case scenario, if something happens to the borrower's ability to successfully get out of the loan, then that's our collateral. That's what's actually underpinning our loan. And so that means that we've lent 60% of the value of that collateral, which means we have a 40% buffer to be able to do what we need to do to sell the project and get repaid.
Keiju, from a lending environment, obviously with the dramatic raise in rates in 2022 and even this year, right. As a lender, obviously you're able to charge more money, so that's attractive. On the flip side, it's a more challenging environment for developers. Are you worried that there's potentially more risk or too much tension between the greater attractiveness of the rates that you're lending at, but potentially more default risk on the developer side of things?
Yeah, that's a great question, and that is probably one of the biggest concerns that we have in today's environment, is making sure that borrowers are able to complete their project. The worst case situation for everybody involved in a project is that you have a project that doesn't get completed for one reason or another. So interest rates have a very material impact on a budget, because the amount that they pay for financing is a large component of that budget. And so in the background, we've done a lot of sensitivity analysis, and we've particularly around the interest rates and the value of the project and how that impacts the risk of the project. And at the end of the day, we are very comfortable with the level of financing that we've provided towards the interest budget. We are comfortable with the sponsorship behind our loan, who in many cases have injected money to support the interest budget needed to complete a loan. And we have a very robust asset management function that continually monitors a loan. For construction loans, often we have inspectors out every month, kind of keeping an eye on how the project is progressing. And our asset management team is collecting data, daily, effectively on the portfolio to make sure that things are moving along. So we are in a very comfortable position. And in fact, for the fund that you are invested in our Trez Capital Prime Trust fund, we've had 0 defaults so far, meaning that none of the borrowers in that fund have breached the terms of the contract.
Keiju, we're invested in the Trez Capital Prime Trust, which is a portfolio of first mortgages on commercial properties. Why don't you tell us a little bit on how it performed last year in a particularly difficult real estate environment, and then what it's looking like in this current environment moving forward?
Right. And I will qualify that we also have a requirement that none of the loan to values on that fund do not exceed 75%. In fact, I think the average loan to value is below 50% on that fund. So it's a very, again, relatively safe fund compared to some of our other funds that we have. And last year, the annual return was 5.5% yield.
On the I-Series.
On the I-Series, right. And this year, our target is 6.8%.
Keiju, thank you so much for joining us today on this installment of Meet the Manager and providing some context to our clients about commercial mortgages. We look forward to seeing you on the next installment. Have a great day.